So far, we've discussed all the principles and technical techniques using the E-mini futures contract. Then we expanded our horizons so that everyone can see that all the principles can be applied to any chart whatsoever. So we looked at some stocks. Now I want to take that a step further and look at some exchange-traded funds. This is all in the spirit of expanding our horizons so that traders recognize that they don't have to limit their trading to just one or two instruments. They have a wide open variety of markets and instruments that they can trade on a regular basis. We're looking at the XLF, which is the S&P Select Spider Financial Fund. It's basically an exchange-traded fund that tracks a basket of stocks throughout the financial sector. But what's more important is it really doesn't matter what it is. All we need is a chart with data, and we can analyze it the same way we've been doing, and we can trade it just the same. Here, we're looking at a 60-minute chart, and this is in the spirit of giving a wide variety of different instruments and different time frames. We've talked a lot about consolidation patterns, and we talked about how many bars or how many candles a consolidation pattern will occur before breaking in the direction we expect it to go. Here we have what I would call a less than perfect consolidation pattern. You can see where the exchange-traded fund broke higher, began to consolidate in what I would call somewhat of a pullback pattern, and broke higher again. And you can see here where it went sideways to slightly lower for about 7 candles before breaking higher. This happens over and over and over again. But that's not really the lesson that I wanted to point out based on this chart. The more important lesson right here is what happens when a pattern fails. In trading, in life, in anything else, we never plan to fail. However, a big mistake many traders make is they fail to plan. Here's what I mean. Here's a bearish pattern, correct? The ETF moved down, moved sideways, which promoted another downward move. That's common and normal market behavior. But as we know, nothing happens 100% of the time. We're not going to be right 100% of the time. So we have to have a contingency plan. We must know where we're wrong. So let's take it a step farther. We have a big down move. When we see a big down move, and then we begin to see a consolidation pattern, in this case a bearish consolidation pattern, we're normally expecting another down move. This was forming a bearish wedge pattern, a bear flag pattern, that will generally go lower as a result. But this one didn't. What happened? Remember from the previous lessons, as long as the stock, or in this case ETF or futures contract, stays underneath or inside of the top of this red candle, and since this is a 60-minute chart, it would be a 60-minute close. Anything above the red candle would negate the bearish pattern. As long as it stayed beneath on a closing basis the top of the red candle, we would be expecting another move downward. This bearish pattern failed. Now what happens too many times when traders take a position and it starts to go against them, they end up trading on hopium. We've talked about that before. They're hoping it goes in their direction. And traders have a tendency to stay in a trade too long. And I'm specifically referring to a trade that's going against them. So here you can see what happened. As soon as we got a 60-minute candle close above the high of the down red candle, that's a failed pattern. We have to close out the trade and move on. That's the chart's way of telling us it's going in the other direction. Because what you'll note is the majority of the time, a failed pattern will give you a significant move in the other direction. Normally, this pattern would release the energy to the downside. You have a down move, sideways consolidation pattern will generally promote another down move. However, what happens when you have a failed pattern like this, it's going to release that same energy in the opposite direction. Now, just because we got a candle that closed above the high of the red down candle doesn't mean the stock, or the ETF in this case, is going to go up immediately each and every candle thereafter. Markets ebb and flow. They go up, they go down. Nothing goes in a straight line, and it's the market's job to make as many traders look like fools as much of the time as possible. The market will try and get you to do the wrong thing at the wrong time over and over and over again. And that's the human emotion part of trading, and that's why most traders actually do the wrong thing at the wrong time the majority of the time, and that's why the majority of traders, unless and until they learn the proper way the market trades, and they learn the proper way to analyze and look at the markets, until and unless they apply principles such as these, otherwise they fail. We don't want failure, we want success. When you follow the rules and you follow the program, you can have success as long as you have the discipline and the desire to do so. So when we see an instrument, a candle close above the high of this red candle, for example, that's the market's way of tipping us off that it's going in the other direction than what we expected from the bearish pattern. Of course, it doesn't do it right away. It goes back and forth for a little while, allowing us to, of course, second guess ourselves that we got out of the trade too early, and then ultimately, as you can see, takes off to the upside. And mark my words, while the stock, or in this case the ETF, was going back and forth in this area, there were plenty of traders getting whipped in and out of this instrument before it went higher. The market will always try and shake out the weak hands. If you follow the rules, you don't qualify as one of the weak hands. So it's very important for us to always look at both sides of the equation. We look at chart patterns that repeat over and over and over again, the ones that enable us to make money on a consistent basis. But at the same time, we must always be aware of the other side of the equation. Where are we wrong? Where is a pattern potentially failing? Where can we ultimately lose money if we're not careful? This business is about consistency and preservation of capital. We don't guess, we don't hope, and we certainly don't gamble. This is not a casino. This is not a game. This is not a toy. This is a real business with real capital at stake, with very real results that are very, very possible. But you have to follow the rules, you have to have the discipline, and you have to be willing to put in the time and the effort. That's what this business is all about.